We are well aware by now that interest rates are moving up, and they are really going up because we have an inflation problem in Australia. In this video, what I want to discuss is the potential for how high these interest rates could get before we start feeling some pain in this economy. If you are interested, keep watching. Hey guys, my name's Ravi and welcome back to Personal Finance with Ravi Sharma. If you're new here, smash that subscribe button because I talk about real estate, cryptocurrency, and financial freedom. At the moment, we're going through a period where inflation is out of control. And inflation is basically another way to say that you're paying tax on the money you save because we are losing the value of our currency. So we're basically signing up to say, well, if inflation is 3%, I am well aware that the $100 I spend this year will be worth a lot less next year because of inflation. So this year it could be worth $100 and the same amount could buy me $97 worth next year. That's effectively what inflation is. Now the RBA has come out and suggested that by Christmas, they could actually hit a cash rate of 1.75%. Now for context, at the moment, we're at 0.35%. So that would mean if we were increasing by 0.25%, that could effectively mean another 6 rate hikes at around 0.25%. Do I think that's realistically going to happen? Well, it would mean that we would have to increase every single month for the rest of this year. Sounds sort of absurd to me.
But hey, anything's possible. I mean, 2 years ago, we pretty much told everyone to sit at home and we'll pay them to stay at home. So yes, anything is possible.
However, as I've said in previous videos, these interest rates don't just affect the housing market. Now, sure, your interest repayments go higher, which means effectively you're paying more towards the house, which for some people means, hey, less demand, equaling the prices to go down. But in addition to that, we also need to factor in that a lot of businesses out there have taken on large amounts of debt for plant and equipment. So they're really growing out their business with the equity they have in their homes. Let's go through a real life example of what this could actually look like in terms of repayments. Here we've got an analysis by Rate City found that the average variable owner occupier with $500,000 as a loan at a 25-year principal and interest loan could see their monthly repayments rise by an extra $106. Someone with a $750,000 loan could be paying an additional $159 per month, and someone with a $1 million loan could be paying $212 extra every single month. And what we can see here is basically how the RBA has controlled their cash rate since 1991. What you can see straight away is we have a series of lower lows. It sort of resembles a lot of Ponzi schemes in crypto, which at this point seems like everything because every chart looks like this, where you have the RBA coming out trying to increase rates and then the system fails and they have to drop even further because they created more of a mess than before they actually increased it. The last time we had an increase was 11 years ago. We've started to increase now. Are we going to see the same thing play out? Well, in my opinion, what happens is every time they want to increase rates, they have to do it so quickly because they're so behind the 8 ball and they're trying to control inflation as soon as possible. So they go out and they say, hey, you know what? Let's increase rates. But instead of doing it over a period of 2 to 3 years, let's go and rampage this over the next 6 months. Everyone's going to freak out. The markets are going to get destroyed. We'll go into a recession and then we'll say,
hey, you know what? We're going to come to save you by pumping more money into the system. Let's repeat this cycle. Let's do it another 10 years.
What we have here is by Christmas, if the cash rate hits 1.75%, a borrower with $500,000 as a loan could be paying as much as $443 extra per month. Now these numbers start getting a little scary. If the cash rate goes to 2.5%, because
hey, if there's not enough fear at 1.75, let's just see what happens at 2.5%.
By the end of 2023, the same borrower will be paying a total of $651 more on their monthly repayments since the hikes began. You can see this in the little table here, where on a $1 million loan, by the end of 2022, if the cash rate was 1.75%, it would be an extra $886, whereas here by the end of 2023, where they expect the cash rate to be at 2.5%, we will have an extra $1,302 every single month. Now, if you have a large, sizable portfolio, this stuff is going to get scary because if you have a $5 million loan and you multiply these numbers by 5, well, hey, that's an extra $4,000 every single month that you're going to have to pay towards your mortgage. But what we don't consider in any of these examples is if it's an investment property. What we are seeing is a rental crisis, and I've spoken about this on the channel for many months. You can definitely go check out one here. I urge you guys to start paying attention to the writing on the wall. We have a severe shortage of houses in Australia. And what doesn't help is when the government comes out with policies to boost more money into the economy through housing, it means one thing. Asset prices will go up, you can increase interest rates, but that might not stop the mass majority of people who have a large amount of cash, a large amount of equity across their real estate already. If they get access to that now over the next couple of months, they can go out and purchase more property. This really does affect emotional markets because when you have people going out taking large amounts of loans on their owner-occupier house, then this starts eating up into their weekly budget. How many people realistically have the budget to offset an extra $200 to $300 per week? Not sure, but this number starts getting scary as we go higher. But that's exactly it. It might be a fear campaign, a full-blown propaganda scheme where they're like, hey, we're only gonna actually increase it by like 1 to 1.5%, but let's tell them it's gonna be 1.75 or 2.5%, so people start cashing up. When they start cashing up, the economy naturally will start slowing down, which means, hey, the RBA did its work without actually doing its work. And that's what we're seeing in the market already. I would say that this is a time for you to reassess your strategy, understand what your risk appetite is, and not get emotional about this market. If you're purely hoping the market falls, well, one thing to consider is that before people lose their homes, they will get rid of Uber Eats, they will get rid of all the times they go to the restaurant, that coffee, they'll go to the 7-Eleven and get the $1 coffee instead of the one down the road for $4.
Damn, inflation's good.
And they will try and save and stack as much cash before actually losing their own home. So it could be short-term pain, but this will be really good for the market as we slow down, gather some steam, people realize the economy is normal, and we can move forward as we have for more than 30 years in the real estate market here in Australia. My personal belief is we will not see these numbers. I think it'll be a lot less than this. However, if we do see such high increases, it is inevitable to see this flow on to the property market as well as businesses, which means we will find ourselves in a recession here in Australia a lot sooner than most people think. I really believe it's short-term pain for long-term gain, and I think that anyone that can really adapt their strategy for a market like this will do really, really well over the next 5 to 10 years as our currency goes to zero and real estate goes to the moon. I'll catch you guys in the next one. Thanks, guys.